Usually, when you think about a nation's wealth, your mind automatically defaults to like a very specific cinematic image.
Right, like Scrooge McDuck or something.
Exactly. You picture this subterranean vault, massive 2 foot thick steel doors, armed guards patrolling the perimeter, and inside just endless static rows of gold bullion and bundled currency sitting there.
Yeah, it's a very binary, kind of comforting idea of national security, isn't it? Like,
Hmm.
the money is either physically locked inside the vault or it isn't.
Right. But when applied to modern central banking, it's fundamentally deceptive.
Oh, completely. I mean, if you look at the balance sheets of a major institution, like the Reserve Bank of India, that static steel vault is entirely the wrong metaphor.
Totally.
The reality is a financial landscape that is fluid, it's digitally interconnected, and constantly exposed to global market forces. It's this breeding ecosystem where the central bank is engaged in a perpetual high-stakes defense of the national economy.
And the stakes really couldn't be higher, which brings us to the core of what we were unpacking today.
Yes.
We are looking specifically at Chapter 19 from the RBI's definitive manual on its functions and workings, the chapter dedicated entirely to foreign exchange, or Forex reserves.
Which is a beast of a chapter.
It really is. Like, if you are preparing for a major central banking or civil services exam, you know this material is notoriously dense. But even if you're just a student of global macroeconomics, understanding this specific chapter is basically like being handed the playbook to India's financial defense system.
Yeah, and our goal in this deep dive is to strip away that density without losing an ounce of the technical precision.
Right.
We're acting as your instructional designers today. We are going to construct a comprehensive mental framework, basically a text-based blueprint for an infographic in your mind.
I love that.
Because if you can map the architecture of this system, the history, the mechanics, the specific rules of engagement, you move way past just rote memorization.
Which is useless on the actual exam anyway.
Exactly. You achieve a systemic understanding that allows you to answer literally any theoretical or practical question thrown at you. Studying this audio blueprint should eliminate the need to reread the chapter entirely.
Okay, let's unpack this. Grab your digital whiteboard or your notebook because we are dividing this into 7 clear exam-ready sections.
Oh, good.
Let's establish the foundation right now with Section 1, Core Concept and Title. If this entire complex system had a massive, bold title and a mission statement at the top of our infographic, what would it be?
Well, the definitive title would be Safeguarding Stability,
Yep.
the Anatomy and Management of India's Foreign Exchange Reserves.
Safeguarding stability, I like it. And the 2-sentence summary.
The primary objective of this chapter is to outline the Reserve Bank of India's statutory role as the custodian of the nation's foreign exchange reserves, detailing the mechanisms of accretion, investment avenues, and comprehensive risk management frameworks. In sentence 2, it explains how the RBI prioritizes safety, liquidity, and return to ensure external payment obligations are met, exchange rate volatility is smoothened, and national economic security is preserved against global shocks.
Safety, liquidity, and return. In that exact order.
Always in that order. It's non-negotiable. That hierarchy is the lens through which every single policy in this chapter has to be viewed.
I always frame that hierarchy like a wilderness survival kit.
Oh, yeah.
Yeah, like if you are venturing into a hostile environment, the absolute first requirement for your gear is that it's reliable. It cannot fail when the temperature drops or if it gets wet. That is safety.
Right.
The second requirement is that it has to be on your belt, instantly accessible. If a predator is charging you, a flare gun is totally useless if it takes you 3 days to retrieve it from some storage locker. That is liquidity.
That's a great analogy.
And only after those 2 conditions are met do you care if the flare gun happens to be like a valuable collector's item that might appreciate in value over time. That is the return.
Yeah, and the temptation to chase that return is really the siren song of global finance. I mean, we are talking about hundreds of billions of dollars here.
Right, the scale is insane.
In the commercial banking sector, capturing even an extra 0.25% in yield on a portfolio that size translates to massive profits.
But a central bank is not a hedge fund.
Exactly.
If the RBI ties up its assets in highly lucrative but illiquid long-term ventures, say, specialized infrastructure bonds or complex derivatives, those assets are entirely useless during a sudden balance of payments crisis.
When the country literally needs hard cash by Tuesday.
Precisely. Therefore, return is strictly an embedded strategy. It's pursued only within the absolute boundaries of preserving capital and maintaining instant access to it.
So to really understand why the RBI operates with such strict defensive parameters today, we have to
Yeah.
look backwards, right? We're moving to section 2, timeline and chronology.
Right, because the philosophy wasn't always this dynamic. Yeah, let's map out the historical timeline, starting in the era before 1991. What was the central bank's primary concern regarding foreign currency back then?
Well, pre-1991, the RBI's approach was essentially static. The primary objective was maintaining what is known as import cover.
Import cover,
Okay. Yeah, the metric was simple, almost alarmingly so. It was basically, if every single dollar of foreign income flowing into India completely stopped tomorrow, how many months could the country continue to pay for its essential imports, like crude oil, fertilizers, and machinery, using only the foreign currency sitting in the central bank?
It's basically the macroeconomic equivalent of a family keeping 3 months of grocery money in a checking account.
Exactly.
It's practical for a closed system, but it totally assumes the only financial threat you face is your own shopping bill.
Which completely ignores the complexities of global capital flows. And that simplistic view was shattered in 1991.
Right, the big crisis.
Yeah, India experienced a severe balance of payments crisis. The import cover didn't just dip, it plummeted to the point where the country had barely enough foreign exchange to finance 3 weeks of imports.
Wow. 3 weeks.
The nation was staring down the barrel of a sovereign default. It meant India would literally be unable to honor its international debt obligation or pay for the oil required to keep the country running.
And this wasn't just like a theoretical spreadsheet problem. The government literally had to airlift physical gold reserves to the Bank of England and the Union Bank of Switzerland just to secure emergency loans.
Yeah, it was a profound psychological shock to the nation's financial establishment.
I can imagine.
It was the crucible that proved the old import cover mentality was dangerously obsolete. A nation integrating into the global economy could not measure its safety net solely by its trade deficit.
Right, which brings us to 1993 on our timeline.
Yes, this trauma necessitated a complete paradigm shift, leading to the formation of the High-Level Committee on Balance of Payments in 1993, chaired by Dr. C. Rangarajan.
Now, Rangarajan is a critical figure in this architecture. His committee made a recommendation that fundamentally rewired the RBI's job description, right? The introduction of market-determined exchange rates.
Exactly.
Because prior to this, the central bank heavily managed or outright dictated what the rupee was worth.
And once you release that control and allow global supply and demand to dictate the value of your currency, you invite intense volatility.
Right.
What's fascinating here is that the Rangarajan Committee understood that in a market-determined system, reserves were no longer just a savings account for buying oil. They became a weapon of market intervention. The focus shifted to using reserves to project confidence and to actively smoothen out violent fluctuations.
Wait, let me make sure I'm crystal clear on how that intervention actually works mechanically.
Sure.
Let's say global investors panic due to some external geopolitical shock, and they start mass selling Indian assets, dumping rupees onto the market. The massive supply of rupees causes the value of the currency to freefall. So the RBI uses its Forex reserves to step into the open market, take its billions of US dollars, and start aggressively buying rupees.
Precisely. By using foreign reserves to absorb the excess supply of rupees, the RBI artificially creates demand, which stabilizes the price.
Okay, I see.
But to do that effectively against modern, highly capitalized global currency speculators, your reserves have to be massive. You aren't just covering a few weeks of imports anymore. You are building a war chest to deter speculative attacks on your sovereign currency.
Which means the way you measure how much money you actually need to hold has to change completely.
Exactly.
And that brings us to 1997 on the timeline and the Committee on Capital Account Convertibility, chaired by Shri S.S. Terapur.
Yes. Terapur realized that measuring reserves against the grocery bill was absurd when the real threat was capital flight. His committee expanded the adequacy measures to include money-based and debt-based indicators.
So what does that look like?
They looked at short-term external debt loans that foreign entities could demand repayment on within a single year. They looked at the total amount of broad money circulating in the domestic economy that could, theoretically, try to convert into dollars and flee during a panic.
It's a much more holistic risk assessment.
It is, and Terapur didn't stop there. He returned to chair the Committee on Fuller Capital Account Convertibility in 2006.
2006, okay.
By 2006, the sheer volume of capital flows, foreign direct investment, massive portfolio investments into the Indian stock market had grown exponentially.
You're right.
The 2006 committee forced the system to look at the size, the composition, and the specific risk profiles of these capital flows. If foreign institutional investors hold hundreds of billions in Indian equities and a global liquidity crunch forces them to liquidate and repatriate those funds simultaneously, the demand for foreign exchange will be astronomical.
It would just wipe them out.
Exactly. The reserves must be adequate to absorb that specific modern shock, which really has nothing to do with whether India is importing too much machinery.
So tracing this timeline from 1991 to 2006, we watched the RBI evolve from a passive bookkeeper managing an import ledger into this active, globally aware financial combatant managing multidimensional risk.
That's a perfect way to put it.
And this evolution continues right into the present day. In August 23, 2021, the timeline notes a major external injection. The IMF made a general allocation of special drawing rights, or SDRs, granting India 12.57 billion SDRs.
Yeah, this was part of a historic global move by the IMF to inject liquidity into the world economy during the recovery phase of the COVID-19 pandemic.
Right, the COVID recovery.
It's a prime example of artificial reserve accretion, where the global safety net bolsters the national safety net without the country having to generate a trade surplus or attract new foreign investment.
We will dive deep into exactly what an SDR is in our terminology section shortly, because it is quite complex.
It is.
But let's close out the timeline with a development spanning 2024 to 2027. The RBI's announcement and implementation of a revised framework on currency swap arrangement for SNRC countries.
Right, SARC being the South Asian Association for Regional Cooperation. This represents the RBI utilizing its massive stabilized reserves to project economic security outward. By establishing a currency swap framework, the RBI provides a defined short-term foreign exchange liquidity backstop for its immediate neighbors.
So if a neighboring country faces its own 1991-style balance of payments crisis, the RBI can swap rupees or dollars for the neighbor's currency, giving them the hard cash they need to survive the immediate shock.
Exactly.
And why does the RBI do this? I mean, it's not just charity, right? It's regional self-defense.
Oh, absolutely.
A financial collapse in a neighboring economy can trigger supply chain disruptions, refugee crises, and regional contagion that inevitably spills over into India anyway.
Yeah, it's an acknowledgement that macroeconomic stability is inherently regional. So that is the historical architecture. We understand the evolution of the philosophy.
Yeah.
But to truly master this material, especially for an examination scenario, we have to look at the exact rigorous terminology the RBI and the IMF use.
Here's where it gets really interesting. This is section 3, key terminology and definitions. Let's look at the exact wording the RBI uses, because for an exam, every single word matters.
It does. Let's build the glossary.
The glossary of central banking. Let's start with the cornerstone. Yeah. The RBI borrows its definition of foreign exchange reserves directly from the International Monetary Fund. The exact wording defines them as external assets that are readily available to and controlled by monetary authorities for direct financing of external payments imbalances, for indirectly regulating the magnitudes of such imbalances through intervention in exchange markets to affect the currency exchange rate, and/or for other purposes.
Okay, let's dissect that. External assets is straightforward. It just means assets not denominated in the domestic currency, like US dollars, euros, yen, or gold.
Yes, but the crucial filtering mechanism is the phrase that immediately follows: readily available to and controlled by.
Very important.
I want to push back on that phrase, readily available, because it seems super open to interpretation.
How so?
Well, physical gold is universally valuable. Real estate in prime global cities is incredibly valuable. If the RBI owned a 50-story commercial skyscraper in the financial district of London, that is undeniably an external asset worth hundreds of millions of pounds.
Sure.
Why wouldn't that count toward the Forex reserves?
Because value is not the same as liquidity. And in a currency crisis, liquidity is literally the only thing that matters.
Right.
Imagine the rupee is under a massive speculative attack on a Tuesday morning. The RBI needs to intervene in the currency markets within minutes. If their wealth is tied up in a London skyscraper, they cannot sell that building, clear the regulatory hurdles, transfer the title, and convert the proceeds into usable cash by Tuesday afternoon.
Yeah, impossible.
The asset is controlled by them, sure, but it is not readily available.
Even physical gold has limitations here, doesn't it?
Absolutely. While gold is a traditional reserve asset, you cannot instantly liquidate 500 tons of physical gold without massive logistical hurdles and, frankly, crashing the market price of gold in the process.
Right, true forex reserves must be deployed almost instantaneously.
Exactly. That is why the bulk of the reserves are held in highly liquid financial instruments.
Which brings us to the next bolded term, the largest component of those reserves. Foreign currency assets, or FCA.
FCA, yes.
The technical definition is multi-currency assets held in multi-asset portfolios following principles of portfolio management comprising the bulk of the reserves.
The emphasis here is on multi-currency and multi-asset. The RBI doesn't just sit on a giant checking account full of US dollars. They hold a highly diversified portfolio.
Okay.
They hold sovereign bonds issued by various foreign governments, deposits placed with other central banks, and highly rated corporate debt. And it's all spread across dollars, euros, pounds, and yen. This diversification protects the overall portfolio if one specific currency or asset class takes a hit.
Okay, now let's tackle the SDR special drawing rights.
The tricky one.
Yeah, the definition is a unit of IMF account allocated to members in proportion to their existing quotas in the fund. I've always struggled to explain SDRs intuitively. They aren't physical coins. You can't buy oil with an SDR directly. I sometimes think of them as like chips at an international casino, but that feels way too frivolous.
Yeah, casino implies gambling.
Yeah.
A better way to conceptualize an SDR is as a potential claim on the freely usable currencies of IMF members.
A potential claim. Okay.
It is an artificial reserve asset created by the IMF to supplement the existing official reserves of member countries. The value of an SDR is based on a basket of the world's major currencies. Currently, the US dollar, the euro, the Chinese renminbi, the Japanese yen, and the British pound.
So practically speaking, if India experiences a crisis and desperately needs US dollars to pay a debt, but they only have SDRs, what is the actual mechanical process? How does an accounting unit become hard cash?
India would engage in a voluntary exchange arrangement facilitated by the IMF. India would transfer a portion of its SDRs to another member country with a strong balance of pay in its position, say Germany. In exchange for receiving those SDRs, Germany provides an equivalent value of US dollars or euros directly to India.
Oh, wow.
So the SDR is essentially a guaranteed, universally accepted medium of exchange among central banks. It allows a country to tap into the global pool of hard currency without having to sell off its other reserve assets under distress.
That makes perfect sense. It's basically a globally recognized IOU backed by the collective faith of the IMF membership.
Exactly.
And speaking of the IMF, there is another key term related to them, the reserve tranche position, or RTP, defined as a component of the foreign exchange reserves held with the IMF.
Understand the RTP, you have to understand how a country joins the IMF. It's somewhat akin to a credit union. When India joins, it is assigned a quota, which is essentially a membership subscription fee based on the size of its economy.
Okay.
A portion of this quota is paid in India's domestic currency, rupees, but a specific percentage, usually 25%, must be paid in widely accepted foreign currencies or SDRs.
So India hands over millions of actual US dollars or euros to the IMF just to maintain its membership.
Yes, but those dollars don't cease to belong to India. That foreign currency portion of their quota is the reserve tranche. Because India deposited that hard currency into the IMF, India has the unconditional right to draw upon that exact amount at any time, for any reason.
Really? No strings attached?
None. Without having to negotiate a loan, pay interest, or agree to IMF policy conditions. Because it is unconditionally accessible, the RBI accurately counts the RTP as a highly liquid foreign exchange reserve.
It's essentially a no-questions-asked line of credit against your own deposit.
Exactly.
Now, these last two glossary terms are, in my opinion, the absolute masterstroke of central bank accounting. They explain how the RBI protects the optics of its own financial health.
They are brilliant, yes.
First, the Currency and Gold Revaluation Account, or CGRA, defined as a balance sheet head where gains and losses on the valuation of FCA and gold due to exchange rate or price movements are booked, providing a buffer against fluctuations.
This account is the ultimate shock absorber. Let's walk through why it is necessary. The RBI holds massive quantities of assets priced in US dollars and physical gold. But the RBI's own balance sheet, its annual report, is published in Indian rupees.
Right. So every day, the exchange rate between the dollar and the rupee changes. If the rupee weakens significantly against the dollar, suddenly the RBI's massive stockpile of US dollars is worth vastly more when translated back into rupees.
Right, and if the RBI operated like a standard corporation, they would have to record that massive increase in value as a profit on their income statement. It would look like the central bank just generated a colossal financial windfall.
Even though they didn't do anything.
Exactly. They didn't actually sell the dollars. It's merely a paper profit caused by exchange rate volatility.
And the reverse is the real nightmare. If the rupee suddenly strengthens or the global price of gold crashes, translating those assets back into rupees would show a multi-billion-dollar loss on the RBI's books.
Which is unacceptable. You cannot have the sovereign central bank's core financial statements swinging wildly from massive profits to catastrophic losses quarter by quarter based on the daily noise of the global currency markets.
It would completely freak out the markets.
It would entirely erode public and market confidence in the institution itself.
So the CGRA acts as an isolation chamber. When the value of the foreign assets or gold fluctuates up or down, those unrealized mark-to-market gains or losses are siphoned off directly into the CGRA. The core income statement remains stable, projecting the necessary image of unwavering financial solidity.
And there is a parallel account for a different type of asset risk. The investment revaluation account, or IRA.
Okay, the IRA. Defined as an account providing a cushion against changes in foreign-dated security prices over the holding period based on market prices prevailing at the end of each business day.
So while the CGRA handles currency and gold price swings, the IRA handles the price swings of the actual bonds the RBI buys. If the RBI buys a massive block of U.S. Treasury bonds, the market price of those specific bonds fluctuates every day before they mature, primarily driven by changes in global interest rates.
Right.
The IRA isolates those bond price fluctuations, keeping them off the main income statement until the bond is actually sold or matures.
Together, the CGRA and the IRA demonstrate that managing reserves isn't just about buying the right assets. It's about engineering a balance sheet structure that can absorb the inevitable volatility of those assets without triggering a domestic panic.
Not spot on.
Okay, so the architecture is brilliant. We have the history, we have the precise terminology. That leads us right into Section 4. Important figures and names. Let's quickly codify the individuals and institutions who designed and operate this machinery. If we were building an organizational chart for this system, who are the key figures?
Well, we've established Dr. C. Rangarashan as the visionary who, in 1993, chaired the High-Level Committee on Balance of Payments. He shifted the central bank's posture from static import cover defense to an active market intervention strategy following the flow to the rupee.
And Sri S.S. Terapur is the architect of measurement. By chairing the Committee on Capital Account Convertibility in 1997 and the Committee on Fuller Capital Account Convertibility in 2006, he forced the RBI to evaluate reserve adequacy against the complex realities of global capital flows and short-term debt, rather than simple trade deficits.
Institutionally, the IMF acts as the global rulemaker and the ultimate provider of emergency liquidity through SDR allocations.
Yeah.
But on a day-to-day operational level, a crucial partner for the RBI is the BIS, the Bank for International Settlements.
The BIS is fascinating. It's often referred to as the central bank for central banks. Why does the RBI park its reserves there instead of, say, a massive global commercial bank like JP Morgan or HSBC?
It comes back to absolute safety. A commercial bank, no matter how large, is exposed to commercial risks, bad loans, corporate bankruptcies, retail panic. The BIS, headquartered in Basel, Switzerland, deals almost exclusively with other central banks. It operates outside of traditional national jurisdictions. Placing deposits with the BIS represents the pinnacle of institutional credit quality. It is as close to a risk-free counterparty as exists in global finance.
And internally, who at the RBI is actually managing this?
It's the Department of External Investments and Operations. These are the specific portfolio managers, the traders, the risk officers who handle the reserve management function. They are monitoring global markets 2047, executing the trades, and ensuring the hierarchy of safety, liquidity, and return is maintained in real time.
Got it. Department of External Investments and Operations. And finally, we note SAARC, the South Asian Association for Regional Cooperation, as the direct beneficiary of the RBI's outward-facing stability through the currency swap frameworks.
Exactly.
So we have the concepts, the people, and the history. Now we need the hard data. This is Section 5, Vital Statistics and Empirical Data.
In numbers.
Right. In any rigorous examination of the subject, you have to know the empirical constraints that govern the RBI's actions. What are the vital statistics? Let's start with a number that represents a massive fundamental restriction on how the RBI can invest its money.
10 years.
Ah, yes. The rule is absolute. 10 years is the maximum residual maturity for debt instruments representing sovereign or sovereign guaranteed liability in which the RBI can invest.
I really want to dissect this because on the surface it seems totally counterintuitive. There are 30-year U.S. Treasury bonds that yield significantly more return than a 2-year or 5-year Treasury.
Right.
And from a credit perspective, the U.S. government is not going to default over 30 years. It's incredibly safe. So why does the RBI explicitly forbid its managers from buying them?
Because credit risk, the
Ah.
risk of the issuer defaulting is only one half of the equation.
The other, often much more dangerous half, is market risk, specifically interest rate risk. And if we connect this to the bigger picture, holding debt longer than 10 years exposes the central bank to excessive interest rate risk, which violates the core principle of safety.
Let's break down the mechanics of that. Bond prices and interest rates basically operate on a teeter-totter. They move in opposite directions.
Exactly. Let's say the RBI buys a 30-year sovereign bond, paying a 2% interest rate. A year later, global inflation spikes, and central banks raise new interest rates to 5%.
Yeah.
Suddenly, nobody in the global market wants to buy the RBI's old 2% bond when they could easily buy a brand new one paying 5%.
Right. The only way the RBI could sell that 2% bond is if they offer it at a massive, massive discount to make up for the lost yield over the remaining 29 years.
And that discount represents a catastrophic loss of capital. The longer the maturity of the bond, the more violently its price swings when interest rates change. If the RBI held 30-year bonds and suddenly needed to liquidate them during a crisis to defend the rupee, and that crisis coincided with high global interest rates, they would lose billions of dollars in the fire sale.
Which violates the core mandate. Safety first. The preservation of capital is paramount. By instituting a hard cap at a 10-year maturity, the RBI sacrifices the higher yields of long-term debt to immunize its portfolio against devastating interest rate shocks.
It guarantees that even in a high-rate environment, the bonds can be liquidated without crippling losses. It is a perfect mathematical example of prioritizing safety and liquidity over return.
Let's hit the next empirical data points, which contextualize the scale of these operations. We mentioned the IMF allocation in August 2021. The specific figure was SDR 12.57 billion, which at the time translated to roughly USD 17.86 billion.
And to see how that fits into the current picture, the total SDR holdings as of the end of the financial year, March 31, 2024, stood at SDR 13.69 billion.
Which is about USD 18.13 billion.
Right. It highlights the SDR as a significant, though supplementary, tranche of the overall massive Forex reserves.
And regarding the regional safety net, the SARC swap framework, what is the actual financial commitment the RBI is making?
Well, for the Indian rupee support window under the SARC INR swap window as of June 27, 2024, the total corpus is $250 billion.
250 billion.
And for the separate hard currency window providing US dollars or euros to neighboring central banks, the overall corpus is US $2 billion. These are hard limits, ensuring the RBI provides regional stability without endlessly exposing its own balance sheet.
Okay, we have meticulously assembled the pieces. We have the rules, the definitions, the numbers, and the history. But true mastery of a subject isn't just identifying the parts of an engine, it's understanding how those parts actually drive the vehicle. We need to map out the systemic cause and effect relationships that govern India's macroeconomic reality. This is Section 6, Cause and Effect Relationships. Let's explore the most profound conceptual dynamic in this entire subject. How does India actually accumulate these massive reserves? The source material highlights a glaring paradox here.
It really is the defining characteristic of the Indian macroeconomic model. The cause and effect chain is this. Because India traditionally runs a deficit in its current account, but receives massive excess inflows in its capital account, foreign exchange reserve accretion happens. This leads to a buildup of reserves that are conceptually categorized as borrowed rather than earned.
This requires a deep dive because it fundamentally alters how we view the wealth in that metaphorical vault from the beginning. Let's contrast India with a classic export-driven economy like China or certain Middle Eastern nations.
Okay.
Those countries build their reserves primarily through their current account. They export millions of manufactured goods or millions of barrels of oil to the world.
Yes, and they receive foreign currency in direct exchange for those tangible goods. They run a current account surplus. That money is permanently theirs. They earned it through commerce.
But India operates differently. India historically imports more goods, massive amounts of crude oil, electronics, gold than it exports. So on a pure trade basis, India has a current account deficit. More money is leaving the country to pay for goods than is coming in from selling goods.
Right.
If the checking account is bleeding cash every month, how on earth do the overall savings, the forex reserves, keep hitting record highs?
Because of the capital account. While India is running a deficit on trade, foreign investors are pouring hundreds of billions of dollars into the country as capital.
Ah,
Foreign direct investment into Indian tech startups, massive portfolio investments by global mutual funds into the Bombay Stock Exchange, external commercial borrowings by Indian corporations.
to use a personal finance analogy, it's like a person whose daily living expenses, rent, food, gas, are consistently higher than their monthly salary.
Yeah,
They are running a personal current account deficit. But at the same time, massive banks keep giving them huge business loans, and venture capitalists keep handing them cash to start new projects.
exactly. If the loan money coming in is larger than the deficit from their daily expenses, their overall bank account balance is going to rise dramatically. They will experience accretion.
Right.
And this is the crucial distinction the RBI makes, that money in the bank isn't truly theirs. They didn't earn it through their salary, they borrowed it.
And investors, unlike customers who buy a product, can ask for their money back.
Precisely. Which leads directly to our second cause and effect relationship. Because these capital flows can be volatile and subject to sudden reversals, often called liquidity shocks, the RBI broadened its adequacy parameters.
Okay, this connects right back to the Terror Report Committee in 2006.
It does.
If your multi-hundred-billion-dollar safety net is largely composed of foreign money invested in your stock market, you are basically living under a constant structural threat. If the U.S. Federal Reserve suddenly hikes interest rates or a geopolitical crisis erupts in Europe, those foreign investors might decide to pull their money out of emerging markets and retreat to the safety of U.S. treasuries.
Yeah, they sell their Indian stocks, take the rupees, and demand U.S. dollars to take home. This creates a colossal immediate drain on the forex reserves.
Right.
Because the RBI understands that its reserves are predominantly borrowed, it knows that traditional import cover is a totally meaningless metric. This led to a strategy that accounts for risk-adjusted capital flows and national security requirements, rather than just import cover. They have to design their frameworks to survive the sudden, simultaneous exit of global capital.
It's an incredibly stressful macroeconomic tightrope to walk. Let's move to the next cause and effect, which deals with the accounting side of that stress.
Well-
Because exchange rates and gold prices are highly volatile, the RBI utilizes the CGRA and IRA, leading to a buffered balance sheet that absorbs valuation gains and losses without destabilizing the central bank's core financials.
We've explored the mechanics of this, but the systemic effect is crucial. It isolates financial noise from institutional credibility.
Right, because a central bank's power relies entirely on market faith.
Exactly. If market participants saw the RBI reporting wild, multi-billion-dollar losses due to simple currency fluctuations, it could trigger the exact panic the RBI is trying to prevent. The accounting structure is itself a tool of macroeconomic stabilization.
And the final cause and effect relationship extends that stabilization beyond India's borders. Because the SAARC region requires a backstop for short-term foreign exchange liquidity, the RBI implemented the currency swap framework, leading to enhanced regional financial stability while longer-term arrangements are made.
This is an acknowledgement of interconnectedness. A severe currency crisis in a neighboring nation destroys demand for Indian exports to that nation, disrupts cross-border supply chains, and can cause global investors to view the entire South Asian region as high risk, potentially triggering the capital flight we just discussed.
Oh, wow, right.
By acting as a lender of last resort for the neighborhood, the RBI preemptively neutralizes external shocks before they ever reach India's borders.
Okay, we are nearing the end of our deep dive. We have built the history, the terminology, the data, and the systemic mechanics. The final piece for our mental infographic, Section 7, is a comparative matrix.
Right, a structured understanding of risk management.
Exactly, because managing hundreds of billions of dollars in foreign assets is basically an exercise in paranoia.
It is.
The RBI categorizes its paranoia into 4 distinct pillars of risk. Let's conceptually draw a table. 4 rows, one for each risk category. Let's walk through each pillar, define the threat, and identify exactly how the RBI neutralizes it with a specific control. Row 1, Category 1, credit risk.
Right, Category 1. Credit risk is the most fundamental fear in finance. The definition: threat to counterparty or issuer credit quality.
Basically, the risk that the entity you lent money to, or the government whose bond you purchased, goes bankrupt or defaults and simply cannot pay you back.
The ultimate violation of the safety first mandate.
So what is the RBI control in this column?
The RBI control is stringent criteria for selection and continuous monitoring of sanctioned limits and developments. They do not chase yields in emerging market debt or low-rated corporate bonds. They deal almost exclusively with sovereigns that have the highest possible credit ratings and institutions like the BIS.
Hmm.
Furthermore, it's not a buy and hold blindly strategy. If a sovereign nation's internal economic indicators begin to slip, the RBI's risk managers will actively reduce their exposure to that nation's debt long before a default ever actually occurs.
Okay, row two, category two, market risk. We've touched on this heavily.
Yes. Definition. Potential valuation changes from interest rates, FX rates, and gold prices. The asset doesn't default, but its market value plummets.
The issuer is perfectly healthy, but the environment turns toxic. And the RBI control here,
The RBI control is multi-layered. Long-term currency exposure reviews, protecting investment value from adverse interest rate impacts by strictly enforcing that 10-year maximum maturity limit we discussed earlier, and utilizing the CGRA and IRA accounts as buffers.
so whatever market volatility does slip through doesn't contaminate the core balance sheet.
Exactly.
Okay, row three, category three, liquidity risk.
Definition. Inability to liquidate assets quickly without price impact. This is a scenario where you are technically incredibly wealthy on paper, but you are functionally broke because you cannot convert your wealth into usable cash in the middle of a crisis.
The London skyscraper problem.
Yes.
How does the RBI ensure they never face this? What's the RBI control?
The RBI control is maintaining a highly liquid portfolio and close monitoring of the portion of reserves convertible to cash at very short notice.
Oh, wow.
They ensure that a massive, specific tranche of their portfolio is held in the most liquid instruments on Earth, like overnight deposits at the BIS or short-term U.S. Treasury bills. They know exactly what percentage of their total reserves can be converted to hard cash, basically within 24 hours.
Which brings us to the final row, category four, operational risk. This one is entirely different. It has nothing to do with global markets, interest rates, or currency fluctuations. It is purely internal.
Exactly. Definition. Risks through internal processes, systems, or human error. It is the risk of a catastrophic software failure, a cyber attack, or most dangerously, a rogue trader within the central bank making massive, unauthorized, speculative bets with sovereign wealth.
Because the history of finance is literally littered with institutions destroyed from the inside out. The collapse of Barings Bank in 1995 due to the actions of a single rogue trader, Nick Leeson, is like the classic example. So what is the RBI control to guarantee that cannot happen within its walls?
The RBI control is the total separation of front office and back office, along with concurrent audits, comprehensive daily to yearly reporting, and using secure, swift messaging.
I really want to emphasize the genius of the separation of front office and back office because it's so critical.
Yeah, let's break it down. The front office consists of the dealers and traders. These are the individuals analyzing the screens, speaking with counterparties, and actually executing the buy and sell orders for billions of dollars.
Okay.
The back office consists of the accountants, the settlement officers, and the auditors. They are the ones who actually move the funds, verify the transaction details with the external parties, and record the trades on the official ledger. By instituting a total systemic and physical separation, you ensure that the person making the trades can never be the person settling the trades and doing the accounting.
It fundamentally breaks the mechanism of fraud. If a front office trader makes a disastrous, unauthorized bet and loses $50 million, their immediate instinct might be to hide the loss to save their career. But because they have zero access to the back office settlement systems, they cannot alter the ledger. When the external counterparty asks the back office for the $50 million to settle the trade, the back office sees an unverified transaction and the alarms instantly sound.
Exactly. It effectively prevents rogue trading or systemic internal failures. You'd need a massive, multi-departmental conspiracy to bypass this control.
And with that final pillar of risk management, the framework is complete.
We did it.
If you have followed us through this deep dive, congratulations on absorbing a massive, densely packed blueprint. You now possess a complete text-based infographic layout in your mind, covering everything from the 1993 Rangarajan Committee to the precise mechanics of the CGRA. You aren't just memorizing definitions anymore.
Right. You understand the chronological evolution driven by the trauma of 1991. You understand why Rangarajan's market float necessitated Terraport's complex adequacy metrics. You know exactly why the 10-year maturity cap exists to fight interest rate duration risk.
You know how the CGRA functions as an accounting shock absorber? You understand the mechanics of an SDR exchange, The supreme credit safety of the BIS and the absolute necessity of separating the front and back offices to prevent internal collapse.
You possess a systemic, interconnected understanding of how the Reserve Bank of India defends the nation's wealth.
You are absolutely ready to synthesize this information on any exam or in any high-level macroeconomic discussion.
But before we conclude, there is one final provocative thought hidden within the mechanics we've discussed that is really worth lingering on.
A final thought to close the framework. What is it?
Well, we spent significant time analyzing the profound difference between reserves built on a trade surplus versus reserves built on a capital account surplus. We highlighted the source text explicitly acknowledging that India's massive forex reserves are largely built on capital inflows, meaning they are borrowed rather than earned.
Right, the vulnerability hidden inside the massive bank balance.
Exactly. I want you to consider the profound strategic and psychological difference this creates for a sovereign nation.
How so?
If a country builds its wealth purely through commerce, by selling goods, the world needs that money is unequivocally theirs. It is permanent, earned economic power. But if your nation's ultimate financial defense mechanism, the very safety net protecting you from collapse, is made of money that technically belongs to foreign portfolio investors who could pull out at any moment, it changes everything.
It means you are never truly secure. You are perpetually managing the anxieties of external actors.
Right. The question to mull over, long after this deep dive ends, is this. If a nation's financial safety net is structurally reliant on hot money and borrowed capital, does that country ever achieve absolute, unshakable economic sovereignty? Or is it forced into a permanent high-stakes diplomatic and financial dance, constantly catering to global market sentiment just to ensure its own safety net doesn't evaporate overnight?
Wow. That is a phenomenal, somewhat chilling reality to leave on. It's basically the difference between owning the fortress outright and just renting it from landlords who might evict you the moment a storm approaches. Well, trust the framework we've built today. Visualize your infographic, study the mechanics, understand the deep cause and effect, and keep diving deep.